Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at JM Smucker Company, also known for their Smucker's Jam. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas on potential stocks to invest in, or value traps to avoid, or just want to help get a better understanding of the financials of any companies out there, make sure to subscribe to my channel. And if you do want me to look at a stock, make sure to leave it in the comments below, since I do frequently get the subscribers' requests. So before we dive into the financials basically of JM Smucker, the first thing to go over is they are a consumer defensive company. And we're going to get a little bit more into the methodology about investing these a little bit later. But to start off with, basically don't expect these to outperform in a bull market, although there are times to own them. And just a little bit more on Smuckers, they're known a lot more for their jam. If you're not aware of all their brands, basically they have Folgers Coffee, for example, the Jif Peanut Butter, Smucker's Jam, like I said, Milk-Bone, Meow Mix, and one of the recent acquisitions, Hostess, and some more brands out there as well. So they have a lot of these well-known consumer staple products that people are fond of and like buying for consumables out there. But let's dive into the stock analysis here. So first thing I sometimes like to look at is you look at the Guru Focus Value Band. They got their own little way of basically doing this. And when companies are fairly predictable and consistent, which I would say that Smuckers here falls into, it can be fairly accurate. And you can see it is sitting a little bit on the undervalued side, but how much is it undervalued? Not super undervalued compared to what you could potentially get from growth stocks or this or that or anything. But as we go a little bit further, we can see right now their P ratio is sitting at 11.52 with a little bit lower forward P ratio of 11.12. So that's quite attractive PE, fairly low, though the forward PE does show there's not a lot of growth or forecasting in the near term future based on the analyst estimates. And if you are looking for a little bit of income, they do have a nice dividend of about 3.68%, and that's with a very good payout ratio of only 0.42, and they do buybacks along the way as too. So that is two ways they are returning capital to shareholders despite their slow growth. So let's dive into the financials here. And then like I was saying with the slow growth, it's over the last 10 years only averaged 3.8% per year, although the EPS has fortunately outpaced that. So we go down, we look at the revenue, and you can see it has been growing over the long trend, but you do get these periods in time where it does kind of stall and doesn't grow much. And again, this is because they are a defensive company, and one of the things they do rely on is acquisitions. And we'll kind of go over some of their past acquisitions and how this has boosted the revenue. And they actually recently have done an acquisition, so this hopefully will boost the revenue a little bit more in the future. So this is one of the things we need to evaluate the company on of, are they good at doing acquisitions? Because that's kind of the business they're in, buying these consumer staple products and then running them well and managing them well. So the first thing to look at the gross margin. This kind of determines the competitive mode. If we saw this significantly declining, this could be a sign that they're losing their competitive mode and would mean bad news. But as we can see, actually, their gross margin is back up to 36.48, but actually the last quarter is almost 37%. And this is from the dip they had in 2022, which a lot of companies had due to the inflation issues, down to 33. So they've kind of shown their resilience. Supply chains have cleared up, and they're getting their gross margins back to where their historical norms have been. And considering their historical norms sometimes have been a little bit higher, around 38 to mid 38s potentially, they do potentially have more room to creep up to that gross margin. Next thing we can see is they do keep good quality, like good control on their selling and general admin. This is not growing out of control, and we can tell this because of the operating margin. So you actually see, even though the gross margin is still basically a couple percentage points below their peak gross margin in the past, their operating margin is almost at their peak operating margin in the past, meaning basically as they're growing, their selling and general admin is growing slower than their overall revenue, which is a really good sign, because what a lot of companies get into problems is basically when they're doing acquisitions or the business model is overall failing, their selling and general admin is going to be growing at a faster rate than the revenue. And this is not what we're seeing with Smucker's Jam. This also speaks to they have been very good with doing acquisitions and incorporating those synergies into their business, as when they do acquire a new business in like here, they're able to kind of trim down that selling and general admin and get those cost efficiencies going. So overall, it's like, looking pretty good for Smucker's Jam in those regards. Next thing I like to look at is the interest income. You can see it goes up and down a little bit, although it has been rising over the long term, which you would expect basically as the revenue rises. And one of the bigger reasons the interest expense has increased basically 200 million over the past year here is because in this last quarter, they do have that new debt from that acquisition they did. So they went from about 35 million paying per quarter to 100 million paying per quarter. So in the next year, we actually are going to probably see this rise quite a bit more significantly above 200. Well, I would probably expect them to start paying down a little bit of that debt. This could be over $350 million in the next year for the interest expense. So that's just to keep in mind there. Right now, we're sitting at a 200 compared to the operating income. We're sitting at about a 1-to-7 ratio. I usually like to look at for at least a 1-to-10 to kind of feel really healthy, which you can see they basically have had in the past, but they have got a little bit less than that. But if they do start paying it down in the future, which I'll show you a little bit later, it's kind of within their history, it shouldn't be too big of a deal. But this is kind of show that they're probably not going to be doing any big acquisitions in the future or in the short-term future, since they have just done one, and they kind of need to get this debt a little bit more under control. And as we go down a little bit further, you can see there was a one-time basically expense here, which is typically they're just writing off non-tangible goods. So a lot of times you'll see these companies, they have a negative EPS. Well, it's not that they actually lost money on the cash flow front. They just wrote off some assets, some goodwill that they don't find, are valuable anymore. And that has to be recorded as basically negative income, a loss there. And it looks like there's a short-term loss, but in reality, that's not really a reflecting what their real earnings are at the current date right now. So even though we are seeing this thing of negative 85 cents EPS, well, it's not really the case. You can see that's just from the one quarter, and all these other quarters are still profitable. And as we do go into the cash flow later, we'll see it. Next thing to look at is basically like the shares outstanding. An interesting thing with them is they kind of do these combinations, which they at least did recently, where they did the acquisition by issuing a little bit of stock to Hostess, or the shareholders of Hostess got a little bit of stock and they got some money. But over the long term, they do also do some share buybacks. You can see basically, at least in 2010 here, there was 118 million shares outstanding, and it has been slowly ticking down. What happened here? It goes up from 103 to 119. Well, they did another acquisition and they started ticking them down again. And now they've done another little bit of an acquisition, and we'll hopefully see them ticking down. So it's kind of interesting how they do this. They do the share repurchases, but a lot of the share repurchases, they end up kind of counterbalancing through these acquisitions they're doing. And like I was saying at the very beginning of this video here, we have to kind of judge a lot of Smucker's jam on, and their future is their ability to do good acquisitions. So that's why I'm trying to hone in on those important things, like what are their synergies of keeping basically the operating expenses under control. Are these good acquisitions, or are they bad ones? So we can see on their balance sheet here, and that's also if they are writing off a lot of assets too frequently, that would be a sense that they're doing bad acquisitions, which there's some and it happens, but as we'll see later, it's not too bad. So you can see right now, basically total current assets are sitting at just under $2 billion. Nothing too impressive here. Very, very low on cash, since they just literally spent all their cash doing an acquisition. As you can see, they had 3.6 billion, and now it's down to $36 million. They have accounts receivable though. Some inventories, other current assets, nothing too exciting. Total current liabilities are sitting at a little bit higher at 2.4. This isn't a great current ratio, but I really wouldn't consider this an issue for them. As you can see, a lot of this is short-term debt and capital leases and these other current liabilities, and typically the current ratio is not a very important factor for larger companies and companies that are especially in a very positive cash flow situation. It is something you need to more pay attention to when companies are getting a little bit of rocky waters. They're maybe struggling to pay their bills, losing a little bit of money, or a smaller cap and can't get that debt. So even though they don't have a good current ratio, I wouldn't consider this a big problem with Smucker's Jam. As you can see, a lot of it is these probably just capital leases and whatever these other ones are that I don't think are a big deal, as they just have been increasing over the long term. And then they basically have total assets here sitting at 20 billion. How does that break down? Well, the one thing we have to obviously take out is the $7.668 billion of goodwill, because this is basically racked up from their acquisitions. And you can see basically from October 2020, the quarter ending October 2023 to the quarter ending October 2024, there was a big increase in goodwill due to this acquisition here. But you can also look at from the January 2023 to April 2023, when we were seeing that basically the negative EPS loss, they wrote down $1 billion of goodwill. But if you look over the long term of this, there is not really that much write-downs basically of goodwill. So this isn't something that's super common for them. Typically their goodwill is increasing because those assets they basically kind of acquired, and the goodwill that's sitting there, they aren't effectively writing it down. Other important thing to basically look at in their is their liabilities now, and they basically have total liabilities of $12.68 billion. As we can see, a lot of this is the long-term debt, and this is the recent long-term debt they've taken. Basically, the year before, they had $4.3 billion, and this is almost doubled with, it's like $3.8 billion of debt they effectively took on. So, but you can see from the past here, when they did do these acquisitions and did have these big jumps in debt here, the following years, they did start paying down that debt. So this is something I would expect them to start doing now. Is they've taken on a bunch of debt. I would expect them to start paying this down quite quickly, since this has been the habit in the past, and they do basically have the cash flow and the earnings to actually support it. And we look at basically their total stockholder equity. It's sitting at 7.56 billion, but again, I always basically subtract the goodwill out of that at minimum, which kind of brings us down to zero. So they're running a fairly tight balance sheet, and really all there is to take away from this is they've effectively taken on a bunch more debt, and based on their history of how they've done this in the past, they're going to be paying it down. But overall, there's nothing really remarkable or that significant or unusual happening in their balance sheet. It's a boring company, like I said. And that's what you get with these defensive ones. So let's look at their cash flow statement, see how basically things are going here. So one of the things I look at is the cash flow from depreciation and compare that to the purchase of plant, property, and equipment. Are they basically replacing everything that's depreciating? And what we can actually see here is I did run these numbers on a little bit longer term, and over this time they've been about, their purchase of plant, property, and equipment has been about 20% lower than their depreciation. So the expenses we're seeing, the EPS, they're actually getting a little bit more cash flow than is actually basically occurring compared to what they're actually repurchasing. And this also might be why they're writing some bad assets off here and there along time. And you can see the reason why they don't actually have to replace all, their assets, and sometimes they're doing basically new acquisitions, as you can see here from these purchases of businesses along the way. And like other times I was highlighting before, what you'll notice was 2015 to 2016. They did a big acquisition for 1.3 billion, and in 2019 they did a big acquisition for 1.9 billion. And the reason why this one isn't showing up here is it's hidden down here for 3.4 billion, and that's because it's cash flow from other investing activities, because it was kind of a split between some share issuance as well. And for whatever reason, Guru Focus here is reporting it down here, even though it probably could be recording the purchase of business up here, but just hiding up there. But let's just look back at some of these dates here again at 2015 when they did the acquisition, and 2019, just to kind of get an idea of like basically what happened with their other financials. So you can see again, when 2014 to 2019 here, or 2015 here, there was a big increase in debt, but then they basically started paying it down. Like after 2019, when they did the other one, we get another increase in debt, but they started paying it down. So again, like I was saying, they have done acquisitions in the past, and they've seemed to manage them quite well. And I just want to go back up here and just look a little bit more at basically these other, because these are typically your intangible write-offs, your non-cash expenses here. And you can see this is the biggest one in history. There's been some smaller ones along the way. The other income expense here is typically these non-basically cash write-offs for depreciating, like writing off basically goodwill and stuff. But you can see it's been relatively low in the past. It is very, very small. So the recent one we've had is kind of the biggest one, which does kind of say, in my opinion, that they have been fairly good at doing acquisitions. So we'll go back down to the cash flow here, and what more you can see basically a lot of repurchase of stock, although they do typically have a little pause on repurchasing stock when they do these acquisitions here. You can see in 2015 when they did this acquisition, the kind of repurchase of stock paused a little bit, and then right around 2019 again, we had a little pause right before and after for the repurchase of stock as well. And then even in these recent quarters, what has happened? Well, they've kind of started saving up cash to basically repurchase again. So we may see them not repurchase stock for the next few basically quarters as they try to get that little bit of kind of debt more under control. And we can see how they basically pay off their debt through the cash flow from financing here. So you can see the debt being issued, and basically there were some debt payments, but the net issuance of debt in 2015 was 1.1 billion. Quite aggressive payoff in 2016. You look at their free cash flow, 1.2 billion, and basically other than the cash flow from dividends, they used most of that cash just to pay down the debt. And that's also kind of a little bit of a similar pattern which happened in the following date after this other acquisition, when they did basically issue another net issuance of $1 billion of debt. The next year, what are they doing? they're basically paying down the debt, and they're using this excess cash flow apart from the dividends to pay down the debt. So they're going to most likely keep the dividend the same or even slowly increase it. You can see over the period of time that basically even during these acquisition periods, they did increase the dividend year after year after year. And they are one of these, I think, they kind of qualify as a dividend aristocrat, I think. They've been paying their dividends since 1993, and this is quite a low amount of their cash flow, so I don't see any real reason they would ever have to cut the dividend at this point right now. So what's probably going to be happening in the future is they're going to be basically paying that dividend out, and any excess cash they have is going to go paying down the debt until they get the debt a little bit more under control, and then they're probably going to start buying back some shares. So, okay, that kind of gives you an overall idea of the financials. Now let's jump into the interactive chart to get an idea of a relative valuation and kind of start going over where I may be seeing a buying the stock, which little kind of thing is I actually have been dipping my toes into it here. So we're going to pull up the revenue with estimate and the EPS with estimate, and you can see the long-term trend is slowly up and to the right. They are increasing their EPS, they are increasing their revenue, and that's expected to happen in the future, even though it looks like they're losing money in the short term here, which we explained they really aren't. It was just a one-time write-off. So let's look at basically the dividend yield, because typically for a lot of stocks like this, you see this typical correlation of that when the dividend yield is relatively high. And you also need to make sure that, as we went over the financials, that they can actually afford that dividend. That's typically been the good times to buy the stock. As you can see right now, the dividend yield is pretty high. So along with all these other financials, this is one of these signals telling me that's relatively cheap. Because what do we see here in 2020? Dividend yield was also high, relatively cheap. 2019 also, 2009, and basically as well in 2000 and even 1997. So every time you've done this, if you bought it basically when the dividend yield was effectively getting over 3%, you probably ended up doing pretty well with buying JM Smucker here. Although you may have not outperformed the market every time, you would have got a nice positive return, and a lot of times you would have actually ended up outperforming the market as well. Another thing I like to look at is the price to sales ratio here. And you always have to look at the price to sales ratio in context of the net margin. That's very important. And you can see there's a very strong correlation with the price to sales and the price. Although the one thing I will note, well, the price to sales for a lot of these recent terms since basically post 2009 is relatively low. This isn't at an all-time low. So it's not that JM Smucker here is excessively cheap. It's relatively cheap, but this isn't, crash level doom and gloom cheap. So even though I am interested in the stock, I have been kind of starting picking away at it. It's something that if they do hit a big actually speed bump, which sometimes things do happen, they could potentially go lower. That is something that you always have to be aware of, that when something was really cheap in 2009 or in 2000, that can always happen again. And I'm going to also bring up the net margin just to kind of compare that, because it's a good idea to see how the margins have been going over the long term. And you can see it's maybe a little bit slowly uptrending basically to the right, other than with this one right off here, but they kind of overall have been increasing it. And maybe back in this pre-2000 time, it was sitting a little bit lower. This is more around, under 5 basically percent, and maybe at 6%, where now things were getting more to 10% and 8%, at least going into before when they, had a negative EPS here. But that does kind of justify potentially a little bit of a higher price to sales ratio as well. Let's also take a look at the P ratio, see if we see anything interesting there. And we kind of have to ignore these like really, weird periods when it goes down to 0, or when you get a really one-off period like this. But if it is actually low, 11p going forward, kind of use that as your benchmark, which would be somewhere about right here. From a P ratio perspective, this is very historically cheap if we do use basically kind of more of the forward P ratio rather than the current negative, basically P ratio from the current negative EPS they have. So we'll get into a little bit of basically the stock chart here, and also just talk about basically when this stock will do good and basically when it won't. So I always like to look at these stocks kind of in these longer term trends, what they're doing, and, kind of establish this slow trend they're basically riding, which is basically up these monthly moving averages. And when they do kind of come into these ones, the yellow or even basically lower, that has been historically a time to buy. So that is kind of one of the times I'm looking at. And you can see they're actually back to the same price they were in 2013. And even if we look at these previous times here, like on the RSI here, when the RSI was getting to about this 35 level, in the past, that's been a good time to start looking at it, though you can get into the stock a little bit early, but that has historically been a good time to buy it. And as Smucker's Jam, like I was saying before, they are kind of more of a defensive company. So if we do look at compare it to something like the S&P 500, you're not going to find it's always going up when the S&P 500 is going up. And this is one of the reasons why getting into these more defensive companies at good prices can be very valuable, because when the market does turn, and the fact is the yield curve is inverted, where I think things still can run for a while longer of the overall market, there's going to be a time when it pivots back into offensive and we potentially hit another little bear market like we did in 2022. And this is when something like, Smucker's Jam is going to be the stock you want to hold, because what happened here basically in the end of 2021 into 2022, the S&P came way down, but Smucker's Jam, while it did chop a little bit, it was net up. So you overall, if you had, even bought it beforehand at the beginning of 2020, you actually would have ended up pretty well running this whole bull run, and you would have been able to sell it at a good price and, buy the bottom and some undervalued tech stocks potentially. And you can see kind of this correlation with the market. And this is sometimes when I like starting to pick away at these consumer defensive stocks, because they do provide you protection for bad markets. You can even see here in 2015, 2016, basically, the market wasn't too strong, but this was a very strong time to be in Smucker's Jam. Another interesting thing was we even go back a little bit further. 2008, everything went down. Smucker's Jam went down less than the overall market, but it still did go down basically. But in 2000, here's another very big, basically inverse here, where Smucker's Jam was hitting a low, basically the overall market in tech was hitting a high. So while the rest of the market was crashing, Smucker's Jam was actually doing quite well. So anyways, this just kind of gives you an idea of why it can be valuable to own basically defensive companies that, while they may over a long term underperform the market, if you can start finding them at attractive prices and then have them when you approach those rocky periods in the market. And sometimes those attractive prices are when you're kind of getting close to those rockier times in the market. That's when you can really do well in those bad times of the market, because not only do you have a stock that's not going down and potentially even going up, that means you're going to have more money basically when other stocks are low, like growth stocks, like tech stocks, and you can buy, sell your defensive stock and do that. And it's also one of the reasons I like picking individual stocks overall to index, because the index, while they contain all these stocks, I can't just choose to sell the defensive stocks when they're up and then buy more growth stocks with it. But if I do hold individual stocks, this is what it allows me to do. So I have been picking away a little bit of Smucker's Jam. I think my average right now is 112 something. I'm looking at potentially basically buying a little bit more, but I'm in no big rush into this. As we've seen, we had a big drop here. It's bounced up. It's kind of coming back down. And this could happen a few more times. It may not be until another year plus until this, takes off and potentially starts running. But at least in the meantime, I am holding a stock that is paying me a reasonable dividend. And if it does get a nice bounce and a nice outperformance, maybe that's going to be a time I look at, potentially taking some profits if it does get a little bit oversized bounce, or I just, keep holding it till a little bit of rougher times hit, and then I'll be, sitting pretty well. But anyways, that's my overall analysis of JM Smucker here. I hope you enjoyed the analysis, and I overall hope my other explanation here of kind of why you actually want to sometimes own these defensive underperforming companies can be a good thing. And of course, make sure to subscribe to my channel, like the video, and I'll see you in the next stock analysis.